Hello everyone, my name is Dr. Heloïse Greeff. I am the person behind the Rubymza portfolio and welcome to my quarterly conference call for Q4. Just to reiterate, the information we will be going through today will be for educational purposes, and I hope you find it useful in making your own investment decisions. If you've been to one of these before, you'll know the agenda. We'll start with a brief introduction. We'll review my investment strategy. We'll then have a look at the market and the portfolio review for the last quarter before we look at the market outlook as well as the portfolio positioning for the rest of the year. So without further ado, let's jump in. I'm Dr. Heloïse Greeff. For those of you who haven't met me yet, I am originally from South Africa. I came to Oxford as a Rhodes Scholar to do a MBA and a PhD in machine learning. I have stayed on in Oxford and I became a full-time popular investor about a year ago now. I continue to manage greeffinvest as well as consult on research projects for different machine learning, AI, and more recently, retail investing. I have had over 175 people follow my portfolio as well as the updates on eToro. I've had more than 20,000 people copy the portfolio with more than $50 million. And this is since the inception of the portfolio in 2000. Just a brief background of my financial journey. I joined eToro, as I said, in 2016. However, it wasn't until 2019 when I became a popular investor. This was after eToro approached me and asked me to make my portfolio public, given the portfolio performance. When I started investing, you can see here that it was a steep downward curve, and this was because I was day trading oil. However, I quickly learned my lesson and the importance of having a disciplined and patient approach to stay true to your investment mantra, and that has been one of the key reasons for my success since I opened the portfolio up for more people to join. I continue to do a lot of media interviews. A lot of it celebrates both my work as a retail investor, but also more recently drawing on my experience of AI, specifically in the field of investing. Before we look at the portfolio, as you know, I always like to do a review of the portfolio or investment thesis, as I call it. This is available on my bio page. So I'd like to reiterate that this is a predominantly growth portfolio, which means that we tend to invest more in growth-oriented stocks or equities and usually take a long-term view, which in traditional investing can mean anywhere from 5 years and longer. And a very important part of this portfolio is that I do prioritize a low to medium risk score, which on eToro means about 3 to 4. This is a very important part of my investing thesis because it underlines a lot of my investing decisions. But as the age-old saying goes, with investing, high risk, high returns. So of course, with more moderate risks, you can also expect more moderate returns. And we will go through that when we look at the portfolio performance. Just to give a bit more detail about my investment strategy, it has 6 core pillars. The first being focusing on growth. And this is specifically long-term compounded growth, which means any profits are reinvested into the portfolio and that growth is compounded over the long term. The second is a focus on decision and risk management. As I just mentioned, I highly prioritize keeping my risk score low on eToro. I have become known for sailing a steady ship, and that's something I pride myself on, and I do not foresee changing that in the future. It's been very successful for my investing journey, and it's something that attracts a lot of my copiers, is this very high focus on risk management to reduce volatility. The third pillar is a focus on fundamentals. Although I use a lot of machine learning in my analysis, I do believe that strong fundamentals are important to give us guidance, especially given the current economic environment. The second layer is what I call uniquely me. So, as I mentioned, I have a PhD in AI and machine learning. So, I do use bespoke machine learning algorithms as part of my technical and fundamental analysis. Those are run in real time to manage and adjust any liquidity and volatility. However, with everything that's going on with AI and machine learning at the moment, I would like to emphasize that I only use machine learning as a decision support tool, and this is by no means a robo investment portfolio or an automatic investment portfolio. I simply use those as additional inputs or decision support to guide my decisions. However, as the head of this portfolio, I do have the ultimate say to decide whether or not to invest in a particular stock and when to sell. Those are all still done manually. The third or sort of middle pillar of this me layer is a focus on low or zero fees. When I was looking for a platform in 2006, for both its transparency but also for its low fees. And I do continue to manage the portfolio in a way where we try and minimize fees in the portfolio, as I do believe that just like profits can compound over the long term, so can fees. And so we do try and hold portfolio positions that don't have excessive exposure to fees on the platform. Finally, is this unique view of looking at the hive mind or the mega trends, which I get to do through the use of AI as part of the larger analysis of the markets, of the retail investor mind, and that's just giving us a sense of where the market is and where things are going. So, with that, let's look at the market review for Q3. Going into the third quarter, investors really went in with this increased confidence that the recession was unlikely to happen this year. And that was in large part driven by the continued healthy job market and the strong consumer spending. And strong gains for shares in the first half of 2023 meant that global equities posted a negative return in Q3, as was the case with government bonds, who also declined in Q3 with yields rising. And there was really very little place to hide in the last quarter. Historically, Q3 or this August to October period tends to be a very challenging period for markets. If you look at this, it's returns from the 1940s. If we average that, we can see that August and September historically tends to be weak, and so a very challenging time. We talk about this every year during this conference call. General stock market indexes have experienced their most significant downturn since December last year. So not only was this a usually challenging time for markets, it was also one of the most challenging periods for this year since December last year. And both the S&P 500 and the Nasdaq each took about a 5% hit. And this downturn continues to trend through the week performance in September. And so we find ourselves really caught in a market scenario that is between very excessive pessimism of the first quarter and then the somewhat complacent attitude as we move or already, strongly into the fourth quarter, with a very noticeable lack of strong investment conviction. And that really leaves us in this limbo state that I have been talking about since the beginning of the year, where we have this ongoing reduced market activity. However, despite the significant events and concerns that we have seen throughout the year, such as the conflict in Ukraine, the strain on the US regional banks, which we spoke about last time we met, a slowdown in China, and the persistent high inflation and interest rates, the markets have largely ignored these factors. Nevertheless, there is a growing belief that the economy will manage a gentle slowdown with a focus on the robustness of the job market as we continue to see these worries about consumer well-being, corporate debt levels, profit margins, as well as earnings continuing into this quarter. And there was really very little place to hide in Q3. I think economic indicators right through from the purchasing managers indexes to the consumer price index are all showing signs of deceleration. And overall, the corporate sentiment has shifted from this optimistic outlook that we saw at the beginning of the year to a more cautious stance as inflation begins to impact consumer spending patterns. And we really can expect that if oil prices are to remain at these high levels, it will undoubtedly affect both the individual consumer as well as businesses. In terms of individual market sectors, as I said, there was really very little place to hide. Energy companies, insurance firms, and managed health care services tended to outperform in the last quarter, whereas there was a noticeable underperformance in the technology sector, where this portfolio heavily leans on, and the more traditional sectors like mining, oil production, telecommunications, and real estate managed to do slightly better. The sort of saving grace in this last quarter has been the Magnificent Seven, as they're now being called collectively, which is a group of AI-centric stocks, many of them in this portfolio. They have showed a downtrend. As I said, there was really nowhere to hide. Value stocks slightly outperformed, including those dividend bears. With outperform, meaning, if the whole market is struggling, it's a matter of being less negative than the rest of the market. You can see here that there was really, really no positive sectors in the last quarter. And by value outperforming, it was only less negative. In the first half of 2023, growth-oriented stocks really led the market, but there has been this notable shift towards value stocks in the third quarter. And that's typically because growth stocks do well when interest rates drop. And earlier this year, there was this really strong optimism and hope that central banks would ease up on the interest rates, which helped these growth stocks push the market up. However, as we have continued further into the year and we've seen interest rates only continue to rise, or now as they recently have remained stable, the market has sort of shifted its direction in the third quarter. And this is really interesting that we're seeing value stocks pull ahead while usually defensive sectors outdo more economically sensitive ones. And this pattern is somewhat atypical in the sense that one might expect it to signal investors' caution due to the recession concerns in Europe and the easing of supply chain issues post-pandemic, which more significantly impact companies that tend to be sensitive to those economic cycles. And in the US, value stocks are also pulling ahead, although not as markedly as in Europe, where those greater focus on energy and finance sectors tend to persist. So despite this trend towards more value investing, I would say the money hasn't quite followed suit, especially not in Europe, where there's still a strong preference for growth stocks. And finally, since crypto does continue to hold its place in this portfolio, we haven't talked about its portfolio in quite some time. In the third quarter, cryptocurrencies exhibited a correction after experiencing significant growth in the initial half of this year. The leading cryptocurrencies by market capitalization, Bitcoin and Ethereum, which is what I hold in this portfolio, concluded the quarter with a decline of approximately 12% each. And we really felt that in this portfolio. I think the exposure to crypto at this point is around 5%, slightly more. And so it's really important to acknowledge that, despite this heavy decline that we've seen in the last quarter, Bitcoin has managed to achieve a substantial increase of 68% for the year to date, and Ethereum is followed closely at 40%. So this is a really noteworthy shift away from their performance in 2022, where we saw a decline in both those cryptocurrencies of exceeding 65%. And so that's one of the main reasons why I continue to hold them in the portfolio. I do still have a strong conviction for the place of cryptocurrencies, and I do believe that simply getting rid of them out of the portfolio, given the declines that we saw in 2022, would just mean that we are selling low and we will not get to experience some of the correction that we have already seen this year. And so although they do remain quite a strong thorn in my side, given how they impact the volatility in this portfolio, I will hold on to them as I do believe that they are part of the long-term portfolio thesis. eToro does the real retail investor beat, which is the survey that some of you may participate in. And that survey has seen quite a market shift away from concerns about inflation, more towards concerns about a recession, which I think is quite well correlated with where the market currently is. However, what I do find quite encouraging about that, and that just shows the mature level of retail investors on the platform, is that many have indicated that they are not planning to pull out, and many are actually planning to continue putting money into their portfolios, which is incredible. That's something I always advocate for, and so I was very happy to see that in the retail investor beats. In terms of the larger market outlook, I think in October the S&P saw a decline as the market digested the possibility that the Federal Reserve might not increase short-term interest rates much further. And so the goal of these rates to reduce inflation to the Fed's aim of 2% is a very tough job because it's trying to do that without slowing down the economy. And if you remember from our last call, I did speak specifically about this expected U-shaped recovery. And that's just because whatever the Fed is doing has this lag effect to when we will start seeing the impact. S&P 500 fell by 2.2% over October, and the most recent economics reports do suggest that the Fed's fight against inflation, unfortunately, isn't quite over yet, but we all knew that this was never going to be an easy fight. I think since the end of last year, I have been saying that we'll have this U-shaped recovery and we can expect a sort of 24-month window as to how long this will take to correct. However, having said that, inflation has eased from its 2022 highs, and the US economy has shown immense tenacity. And altogether, the S&P 500, along with this portfolio, is still positive for this year. And as investors are looking ahead, I think there's a strong expectation that Feds might start to slash interest rates more assertively in the early months of 2024. However, I do think that's led to be seen. For active investors like myself, it has been a very busy year in making sure that we adjust exposures to different categories based on this tumultuous expectation and reality of what the market actually does. But it's not all doom and gloom. In the wake of this pullback or this significant drop that we saw in the third quarter, I do also see several opportunities to adjust the portfolio to go into a strong position for 2024. As I say, we do remain on a strong inflation and interest rate watch. These continue to be the main drivers for stock prices over the last 2 years. If you've been to any of my calls, you'll know that this is something that we continue to talk about, and it will continue to be an important part of the remainder of this year. We also see prices of everyday goods, as measured by the Consumer Price Index, rise by 3.7% in the last year, in September, which is a decrease from the 2022 high of 9.1%, but still a well way off the Fed's target of 2%. There is a strong expectation that the US economy will slow down soon. And that's purely because we've seen Americans save less in the third quarter than they have previously, which does suggest that the high prices and the rising interest rates are starting to impact that strong consumer spending that we saw pull the market through in the first half of this year. And that really comes back to the sort of U-shaped recovery that I've been talking about since the end of last year. Overall, the US economy has been stronger than expected, and the actual growth is probably more around 2.4%, as experts kind of estimate, which is much better than the Fed's estimate of 0.5%. And that's really bringing into question the traditional forecasting tools that the Fed relies on. And it's giving the strong push towards using more recent data rather than using future projections to decide on economic policies, which in future, if this does happen, will hopefully reduce the lag between economic policies and how they react to somewhat dated data. So as I mentioned just yesterday, on the 1st of November, the Federal Open Market Committee decided not to change the interest rates after having increased them 11 times since March 2022. However, they have hinted at one more possible hike before the end of the year. But the bond market didn't quite expect any more increases for 2023, and there's only around a 20% chance predicted. So only time will really tell. On average, it takes about 2.5 years from the Fed's initial interest rate hike to a recession to commence. And just to remind ourselves, the first hike happened in March 2022. And as such, the Federal Reserve is really at that crucial stage in their fight against rising prices. And the next few months, whether they decide to have that final rise before the end of the year, will really be pivotal in deciding whether they can avoid a recession while also calming inflation. In August, we saw the home sales in the US hit a 13-year low, and that has really brought about some worrying signs about increasing credit card debt and late payments, which does suggest that people have started cutting back on their spending. However, the strong job market is the most persuasive evidence that the economy might be able to avoid a hard crash. The US has been able to add over 300,000 jobs in September, which is almost double the number that was predicted. And similarly, pay has gone up by 4.2% from last year, and very few people are out of work. I think the employment rate is about 3.8. As I say, it's too soon to make any firm predictions for the end of this year, but overall, investors should be prepared for a slowdown. And that's really because we've been seeing this odd contrast between the strong economic figures and data that's coming out, as well as the falling stock market in the latter half of this year. And that's really quite puzzling that even in good economic growth, the stock market is not doing well, because usually those two are correlated. And that's, I think, really hinges on the fact that investors are mistakenly thinking that the economy can only grow when interest rates are zero, which is not the case. And hopefully, they'll realize that sooner rather than later. Now, overall, as the economic outlook remains quite uncertain and market activity remains muted, there is also a lot of reasons for investors to be optimistic going into November and beyond. So let's look at the portfolio performance. I get a lot of comments on my page around the portfolio performance, and the reason I like to put up this slide is the fact that it highlights the utmost importance taking a long-term view. Since the inception of the portfolio, if we say that you invested $1 in the beginning of 2017, that would be almost 2.5 times your original money had you just held on to your investment since then. And that is really going back to this compounded growth. And despite these volatile up and down fluctuations in the portfolio, in the market, over the long term, if we average the return and smooth it out, we can see that the portfolio performance pulls away from the S&P, which is what eToro uses as the benchmark for their investors. And I really would like to reiterate this. Of course, it does depend on when you join the copy, what the market conditions is at that point in time. Some of you are commenting that you've been copying for 2 years and you may not be seeing the profits that you are expecting. Again, I'd like to reiterate that this is a long-term portfolio, and I do hope that you will be patient and that you will be rewarded for that patience over the long term. I have personally more than doubled my money in my eToro portfolio over the lifetime of this portfolio. A second point I would like to highlight, because I get this quite a lot. I was quite hesitant to put this slide up, and I do hope that I don't regret it. This is by no means intended to break down any other portfolio on the platform. If anything, I think there are a lot of great popular investors on eToro, especially in the elite and elite pro category. A lot of these colleagues of mine are not only wonderful, wonderful people who I look forward to seeing again at the eToro conference in Abu Dhabi later this month, they are also fantastic investors. So this comparison is purely because I am trying to explain the investment strategy and how it works. And I often get comments that compares me to other popular investors. And while I can see the reason why you do that, it's not really comparing apples with apples. In the slide, you can see that I'm the only top popular investor. And if you go on eToro, this is a screenshot from the eToro page. I'm the only top popular investor who has been able to give a positive return in the last 12 months with a risk score of less than 5. And why is that important? That's so important to reiterate that you know what you're choosing when you are copying somebody. Because if you remember, my investment strategy says I prioritize low and medium risk score. And not only am I one of the only top popular investors who are able to get a positive return, you can also see that my weekly drawdown is much, much less compared to others. And this is just to highlight the difference in portfolios. We often get compared to one another, but our strategies may not always be the same. And I do encourage you to go onto your popular investors page and look at what they've written on their bio. Hopefully you all read this when you copied me. The drawdown is how much the portfolio fluctuates in a week. And that's really sort of your appetite for risk. How comfortable do you feel with the portfolio fluctuating really wildly? And the age-old saying of investing in the capital markets, or any sort of investment for that matter, is high risk, high return. And similarly, if we are sticking to a very moderate or medium risk portfolio, we should also adjust our expectations for the returns accordingly. And this is something that I am really, really proud about, because being able to have a portfolio with a risk score and to be profitable in the current market adjustments is, as you can see, just not commonplace on the portfolio. And as always, I do encourage you to perhaps diversify amongst different popular investors, but make sure that you understand the individual investment thesis. Mine is to have and to prioritize a medium risk score. And that's really important because that underlines every decision that I make, and that does influence the portfolio, how wildly it fluctuates every week with a drawdown. And it is something that I love to celebrate. And when I get questions about it, this is sort of the way that I would like to encourage you that, of course, performance is one thing to compare in a popular investor, but like many other investment opportunities, there is also the risk score, there is also the drawdown to consider. And so make sure that you choose something that aligns with what your investment objectives are. Mine is to keep a medium risk score. It has been since this portfolio started in 2016, and you should really be concerned if I change that overnight. You should really be concerned if I start doing, loads of short selling or wild things to try and make profits and maximize profits. Because I think the most important thing when you copy somebody is you want them to be of sound mind and judgment, and you want them to deliver on what they promised you when you copied them. And I am so proud to put this up on the screen because that's exactly what I have been delivering. And there's not many other popular investors at this level that's able to do that. And, that's totally fine. Their investment strategies might be different to mine. So just something to look out for. All right, let's get into the weeds of the portfolio. How do I keep this medium risk score? So when we met in January, I had some hedging. I had some very low risk, but also very high risk. That's because at that point in time, I had taken some short positions to try and minimize the exposure. Very few, I would say, I think less than 2% of the portfolio. One of the other significant things which I talked about in January, I think in May also when we met, was the number of assets that I'm holding in the portfolio. It used to be up to 60 assets. I currently have around 25 assets in the portfolio. So that means it's also shifted the dynamic of the risk management, because the fewer assets you have, typically, the more exposed you are to a single asset, which means that it can fluctuate a bit more if you're exposed to a single stock. However, despite doing that, as you can see, I have kept the risk exposure in that low and medium risk bracket, which is in line with my strategy. And the pure reason for doing this is just making sure that we are diversified in different sectors and not just holding a wide variety of stock, but really focusing on that diversification. All right, so the portfolio outlook for the rest of the year. The last time we talked, I did mention that I've been doing a lot of interviews around AI and machine learning, specifically for retail investors. I was very fortunate to be at the CogX conference where I was invited to speak about the use of AI specifically for retail investors. That's because I am one of a few retail investors who have been proactively using AI since 2016 in my portfolio management, and opportunities like ChatGPT, which is now included in the eToro search bar, has really made that more accessible to investors who may not have an AI background. But of course, that also comes with its risks. And so I've been talking a lot about how do we differentiate and distinguish between investing in companies that are using AI and using AI to invest. So traditionally, this portfolio has been largely focused on tech and healthcare stocks. Because I did biomedical engineering, that was where I was comfortable to invest. However, as my understanding of AI and as the AI field itself is changing and evolving, this portfolio is moving more towards investing, not only using AI to invest, but also selectively choosing companies which are either directly or indirectly involved in AI. And I think we'll see more and more of that. As I've mentioned before, tech has now become so infiltrated in all the different sectors. I always hate having it as a different sector by itself because it's in healthcare, it's in utilities, it's in agriculture, it's in almost every sector. So having tech by itself simply doesn't make that much sense anymore. And although it's very, very early days for AI, I do believe that we will see this shift towards companies that offer valuable services who may or may not highlight their use of AI and benefit from that competitive advantage. And so with my expertise, I think the shift is somewhat towards choosing companies that are using AI, that are having a competitive advantage, and that's purely to make sure that we do profit from this very fast-growing industry. Another significant shift that you would see in the portfolio is our exposure to India. For those of you with keen eyes, you will know that I have introduced exposure to India through a emerging market ETF, which is unfortunately the very limited offering on eToro at this point. But yeah, I have done that probably for the last year. However, in the last quarter, I've increased that exposure to nearly 5%, which is quite a significant holding for any single position. Although it's not really a single position, it's an ETF, which means we have exposure to a lot of Indian companies. However, since it is such a big decision, I would like to talk a bit about why I have decided to do that and why I've decided to increase our exposure to this particular market. So the main driver is because I truly believe India is positioned for growth. It's currently one of the world's fastest growing large economies, and in the second quarter of this year boasted the highest economic growth in the world. And if you think of a country's economy like a company's financial health, then India as a country is really, really strong because it has a lot of foreign currency saved up, its debt levels are relatively low, and it's not spending much more than it earns. Both in terms of government budgets as well as in international trade. So this, to just put a wrapper around that analogy, having a country like this is really like having a very, very good savings account, very little debt, and that really helps a country to handle financial challenges a lot better. I think it's something that we've seen India come out of the pandemic a lot stronger. And if you know me also, I do like to invest in things that I can see and that makes sense to me logically. The last time we met, I spoke about how when you are in London, you can really understand why countries are struggling to get inflation under control. If you're anywhere in London, in any restaurant, people are just spending money. And so it's really hard to bring inflation under control. And similarly, I travel to India for business quite often. And when you go there, there's just an energy that has emerged from that country post-pandemic. And the reports and the data sort of back that up to show that India's manufacturing and service industries are both growing, which is great because it means businesses are busy, especially with orders from other countries, and you can really see that on the ground. The Indian stock market is also reflecting this growth and optimism. The other thing that has really drawn India to being in the portfolio as much as it is, not only because of the strong economic growth that it's showing, is really because I believe the country the country's economy is in the midst of a digital transformation, and it has a lot more runway compared to countries like China and the US. For a traditionally service and IT oriented country, they're very, very well placed to take advantage of what's happening with AI at the moment. And so a lot of opportunities are emerging in digital industries in India, like e-commerce, electric vehicles, and renewable energy. Compounded with that, we also see this strong consumerism and premiumization, which comes from a very favorable demographics, really strong rising income levels, a ballooning middle class, upward mobile, and local consumption patterns that are really driving demand for premium goods. And so I do believe it's a very strong economy, and so that's why I have given a bit more weighting to that economy through the ETF, which is available on eToro. All right. In terms of the portfolio positioning, as I said, this portfolio continues to be a growth portfolio. As with the rest of the year, our cash balance tends to fluctuate. When I did a snapshot in preparation of this yesterday, at the end of October, we were around 43%. I get some questions about it, but it really depends on the day that you check. This is really just to give me opportunity for a bit more shorter term positions. Now, I would redefine shorter term. Like, I got a question about taking a short sell position on the NASDAQ the other day. A short term position in a long term portfolio is not day trading, in my view. It can mean short term, as in a few months, that we are taking a position and trying to profit from it. That's what I define as short term in this long term portfolio. And so, given with all the uncertainty that's going on, as I said, with the strong pullback, there are a lot of opportunities, but it means we need to have the cash on hand to be ready to take advantage of that. It's also creating a bit of a buffer against the volatility, but we can expect that money to continue flowing in and out of the portfolio for the remainder of this year. So, what can you expect from me? As I say, I'll continue to do the scenario forecasting. It's been a very busy year for active portfolio management with everything that's going on, and dynamically readjusting the portfolio, which just again reiterates the case for having the cash available to take advantage of these opportunities. Overall, the portfolio remains net long. That doesn't mean there isn't the odd short position, which I use for hedging in the portfolio. But as I said, as we've gone over the investment strategy, it remains a net long portfolio. And I also commit to remaining transparent and regular in my communication. What do I expect of you? Please ask any questions. I think I've recently found it more useful to communicate with some of you on LinkedIn. Of course, as ever, I'm trying to be as available as much as I can. Having said that, my priority does remain with the portfolio management. In a recent poll that I did, I asked, what do you expect from me? Is it educational material? And the majority still said that it's portfolio performance. And so that's the one thing I do prioritize. Do continue to review your portfolio and your stop losses. And as always, if you know me, if you've been a copier for a long time, you will know that my investment strategy and philosophy is based around patience and discipline, which is my golden rule for investing. And for me, that means as much as possible reducing the volatility in the portfolio, but that does require patience in a long-term portfolio. And I do believe in the long term, this year, last year, 2 years of drawdown will be a blip in, a 10-year portfolio, which is what I am committed to in my eToro portfolio. That's why I'm not currently selling everything and starting to try and do all sorts of different things to try and maximize profits. I did that in the beginning. I've learned the hard way that patience and discipline is, in my opinion, the only way to be successful. It's what this portfolio is built on. And so with that, I always encourage my copiers to make regular deposits. I know it's a very difficult time. I continue to, in my personal capacity, continue to invest in the stock market whenever I have some spare income. Just because I think the stock market, with its current pullback, is really well priced to go in. Do join my mailing list. It's on the QR code on the top. I'll be releasing the recording for this shortly, and I do have some event invites coming up, so join my mailing list, and I look forward to seeing you next time. Thanks so much for joining, and keep well. Goodbye.